his left is Kate Judge, who's a law professor at Columbia Law School and one of the superstar financial regulatory professors in America. Very sensible, very persuasive. Great to have her on the panel. Next to her is John McDonald, who's on a sell-side research analyst covering the banking sector at Truist. He's going to give us a perspective of investors on stress testing as much as possible as opposed to that of the banks. And then Till Sherman at the end of the row there is a global head of finance and risk at Oliver Wyman. He's also really important for this panel. He was one of the designers of the Supervisory Capital Adequacy Program, or SCAP, in the aftermath of the financial crisis, which was really important, probably why we have stress testing, at least in the U.S. today, because it was so successful. What we're going to talk about are sort of the key policy issues, some of the policy issues that need to be decided by the Fed in the short term on stress testing. I'm going to try to leave time at the end for questions. It will be sort of an interactive panel. I also know that there are a lot of journalists, public policymakers, and other people in the room and on the video feed that may not be stress testing experts. So I'm going to take about 5 minutes to provide a little bit of background and define some acronyms that you're probably going to hear a lot more on this panel than you did on the other ones. So just real quickly, this is very basic. The U.S. capital requirements are obviously based on the Basel Capital Framework, which, as Randy Quarles mentioned, the Federal Reserve had an important role in designing. And the Basel Capital Framework has 3 pillars, which is actually important to understand for purposes of understanding the discussion that we'll have on this panel. So Pillar 1 defines each firm's minimum capital requirements. The most important minimum capital requirement for our purposes today is the Common Equity Tier 1 risk-based capital ratio. It consists of a minimum CET1 capital ratio of 4.5% plus a capital conservation buffer of 2.5%. And the largest banks, known as global, we've talked about this, obviously they have the GSIB surcharge as well, which ranges currently from 1 to 4.5% in the United States. Pillar 2, and this is going to be important, the difference between Pillar 1 and Pillar 2. Pillar 2 is the highly discretionary supervisory review process, and then Pillar 3 are public disclosure requirements. So stress tests are designed to determine whether the minimum capital requirements of the largest U.S. banks would be sufficient to weather a severely adverse macroeconomic scenario and still be able to function as viable banking entities. Is the second part that surprised me when they first came out. I thought the point of stress testing is to make sure they had enough capital to survive, but in fact, we've had a higher standard, and I think in retrospect, that was the right choice. During the period of great uncertainty, the Federal Reserve performs what is called a supervisory stress test, and then the banks perform their own company-run stress test. And the first supervisory stress test in the U.S. was performed during the aftershocks of the 2008 financial crisis, and it was called the Supervisory Capital Assessment Program, or SCAP. During that period of great uncertainty, the stress test was used to provide an independent assessment of the capital adequacy of the U.S. banks, and that actually had a big calming influence on the market at the time. Coming out of the global financial crisis, the Dodd-Frank Act established an ongoing role for stress testing. It requires the Federal Reserve to conduct an annual supervisory stress test known as DFAST. It also requires us to disclose the key results of these annual tests, including projected losses, net revenues, and resulting capital ratios for each bank. Until 2020, the Federal Reserve also used the DFAST to evaluate the capital adequacy of the largest U.S. banks in a process called the Comprehensive Capital Adequacy and Review, or CCAR. CCAR originally had 2 components, a qualitative assessment and a quantitative assessment, and the Federal Reserve could object to a firm's capital plan because of deficiencies in either the qualitative or quantitative component. Since 2020, the supervisory stress test has been used to replace the capital conservation buffer. Remember, I mentioned that was 2.5%, with a variable buffer known as the stress capital buffer, or SCB. The SCB eliminated, or this new regulation eliminated the qualitative assessment, which got into the normal governance and control supervisory process. And that meant that the CCAR ceased to be a pass-fail exercise, which it had been up until that point. The SCB can be more than 2.5%, but it cannot be less. The SCB is the only buffer that non-GSIB banks are subject to, and the GSIBs, of course, also have the GSIB surcharge. In 2023, the Federal Reserve started using exploratory stress scenarios. The exploratory scenarios were designed to provide additional information about risks that are not typically captured in the stress test, but without actually affecting the capital requirements. Mainly because of difficulties in projecting trading losses and net revenues, and honestly, because of weaknesses in the Federal Reserve's supervisory stress test and stress models, the results of its annual stress tests have been quite volatile from year to year. The Federal Reserve has tried to address this volatility in two ways. First, by additional transparency about the models that would allow the banks, academics, and broader public to help the Federal Reserve identify and fix flaws in its model. And second, and most recently, we proposed a regulation to average the results of the stress tests over a 2-year period to reduce the amount of volatility. So with that background, I'm now going to turn to the questions on the panel and then kind of elaborate on what we've seen in terms of volatility. So that if you've looked at the 2025 DFAST results, which just came out, they showed an aggregate drop of 1.8 percentage points in the CET1 capital ratio compared to an aggregate drop of 2.8 percentage points in the 2024 DFAST results, which is a pretty big variation. That volatility is partly explained by the scenarios, which turned out to be less severe in 2025 than they actually were in 2024. But part of the volatility is attributable to flaws in the supervisory models. Now, in 2019, you'll see where I come on this. I gave a speech at a Federal Reserve internal conference on stress testing, where I think it was entitled Making the Case for Full Transparency in Models, Scenarios, and Outcomes of the Supervisory Stress Test. The principal justification, at least in my speech, for full transparency is that it allows the banks, academics, and the public to help the Federal Reserve identify and correct flaws in the supervisory models. The principal argument against full transparency has typically been that it's like giving students the answers to an exam in advance, allowing banks to game the stress test. Okay, so Till, let me start with you. So with that introduction, what's the best way for the Fed to address the problems of flaws and volatility in its supervisory models? More transparency, averaging, adjustments to assumptions, or something else?
Thanks, Randy. Thanks for the introduction. Thank you also to Governor Bowman and the Fed for putting on this amazing conference. It's really been a tremendous discussion already today. So of the three elements of the capital framework that you described, stress testing is by far the most model dependent. So it's right for us to spend a lot of energy, a lot of time looking at models and whether or not those models are in fact robust. Models, of course, are not reality. They're a representation of reality, and they're a representation of reality that gets more and more complex. So I have sympathy with what Mike Mayo articulated earlier today, which is, I want something simple, but I want something strong. Part of the framework that we have is simple, but there has to be a place where the complexities and the increasing complexities of our world can be in some way represented and addressed. So these models have, therefore, limitations. The supervisory models have limitations, and the bank models have limitations. More transparency will help some, but I think we're kidding ourselves if we think that more transparency is going to result in perfect models. What I'm most concerned about actually is that the models will become sclerotic, that the models are not going to adapt sufficiently well and sufficiently quickly to the changing environment, but also to changing risk-taking by banks. I don't know if transparency will either make them more or less sclerotic, but for sure, that's one of the things that we need to worry about. So if the public puts a stronger eye on those models, if it helps to mitigate against this risk of them becoming static, stasis, and sclerotic, I think that would be a very good thing. They are, to your point, one of the sources of volatility in the stress capital buffer. The other two are changes in scenarios, which you mentioned, but there's one more, and that's a change in bank portfolios and the business mix that banks have. I think the latter two actually are the biggest drivers. I don't think that changes in models or so-called imperfections of models, recognizing that all of these models are going to be imperfect, are really the biggest drivers. It's the changes in scenarios and the changes in portfolios. So that leaves us with a question then, okay, what do we do about this volatility? On the one hand, the volatility might just reflect the realities of life, that the risks are changing. And that's one of the real strengths of stress testing. It dynamically evolves to adapt to those risks. But it also makes, as was clear in some of the earlier discussion today, it makes capital planning really hard, and I have a lot of sympathy for that. So then we come to like, well, what do you do? One of the proposals that has come out is to average across 2 years. You've got one scenario, you've got a number. This year, you have a number last year, you take the average of the two. I would candidly rather than average one scenario across 2 years, I'd rather average 2 or 3 scenarios in any given year in this year to really capture a much broader sort of scope of risks. Now, you know, for those of you who have been doing stress testing for a living at banks, you know this is an enormous burden to actually crank the machine, write down all the documentation, do all the review and challenge. And the burden has really sort of gotten, frankly, out of hand. So I would, in that sense, like to see a reduction in that documentation burden, that governance burden, and then perhaps in exchange, we can get more than one scenario in any given year and take the average of those rather than just one scenario over 2 years.
Thanks a lot, Till. That's great. So, Kate, what would you choose? More transparency, averaging, revised assumptions, or something else? And sort of to the extent you can, why or why not?
Yeah, I mean, I think building directly off of Till, I would separate out the two different issues. I think averaging is meant to deal with a number of challenges. To the extent the challenge is the model is broken, we should fix the model. We shouldn't use averaging to try to correct an error of the model. That being said, as has already come up much today, it is more challenging for banks to try to figure out capital planning when there is significant volatility from year to year. You want scenarios to be different. You want to be testing for different things from year to year. And so you don't want, in an effort to make sure we don't have too much volatility, you're actually shying away, and I think we've seen this, from testing out different types of risks. And so in that sense, I think averaging can serve a very positive purpose apart from the model. In terms of transparency, I think a lot of the question is, transparency to what end? And is it helping to support the rigor and the efficacy of the test, or is it potentially undermining it? I happened to get like an email from Gallup this morning, and one of the first headlines was like, trust in institutions is just at an all-time low in the United States, right? So like banks, it's between 20-something and 30-something%, depending on who you're looking at. But basically, if you look from like the 1970s to today, you have this very clear downward secular trend in terms of trust in institutions. And I think a lot of government rightfully thinks about, well, we're going to build up trust by promoting transparency, and I think there is a greater burden on the government to be transparent and have that be a mechanism through which you promote accountability. But I think ultimately the way that you build up trust is you do your job and you do your job well. So I think the key question here is this going to help enhance or undermine the efficacy? The best thing we know historically, I was walking with Scott Frame on the way in here, and he did a tremendous paper back when I think he was still at the Fed, looking at OFEO. So, I mean, stress tests started for the banks in 2009 with Till and others with this great effort. Fannie and Freddie were earlier to it. OFEO was earlier to it. They realized stress testing is going to be incredibly useful. And they said, look, we want full transparency. We want to make sure that the model is robust. So we're going to go through this notice to comment process and come up with a really robust model. They came up with what seemed like a really robust model. But then partly because they'd gone through this notice and comment comment process, it was really, really difficult for them to update or change that model. So again, it became overly static over time, and when it became overly static, you ended up with a situation where they failed miserably, OFAO no longer exists, and it no longer should exist. So I don't think that's like the right direction to go. So I think when we're thinking about like what are the mechanisms of engagement, there's a lot of really smart people in this room who are also incredibly knowledgeable, others watching online, figuring out whether it's a conference or other settings, how can we promote frank dialogue and learning. I think it's a really important end, but I think you want to be really mindful of, are you doing this in a way that continues to enable dynamism and learning? I think one of the themes that came out of this morning's conversation is that oftentimes where there's problems, things are overly static and they're not changing. So we want to make sure we're not doing it in a way that introduces unnecessary or counterproductive rigidity into the system.
So John, you obviously advise and sort of analyze U.S. investors. What do U.S. investors think of the Fed's current approach? Would they prefer more transparency, averaging, something else? And how valuable do you think averaging actually would be for investors?
Yeah, so I think investors share many of the concerns expressed already and would be supportive of these proposals, even if they're not perfect. If you think about investor concerns, the first is the over-reliance on a single scenario. That's definitely a concern. Also, the investors feel the scenarios have become a bit stale and at times focused on yesterday's risks. In some ways, it feels like we keep replaying the great financial crisis over and over on a loop each year with the test. So some dynamism and new scenarios would be welcome, of course. And the biggest issue investors have is unexplained volatility. It's not just volatility, it's unexplained volatility. When we look at the results, we can look at two banks that look quite similar in risk profile and end up with very different SEB results in the same year. If you look at the same bank over time, we can see big swings in an individual bank's SEB and hence their minimum requirement, sometimes 100 basis points or more, even when there's no visible change in that bank's risk profile that is detectable to the market. Sometimes there's no change that's detectable to the bank itself. So that unexplained volatility has hurt credibility of the stress test process in the eyes of the market. So as a result, investors are strongly pro-transparency on the simple view that sunlight is the best disinfectant. Get the models out for public scrutiny, put the scenarios out for comment so there can be a public debate about what risks are being tested and which business activities are getting a thumb on the scale in the stress test process each year. In terms of averaging, I think, again, it's not perfect, but averaging does dilute the reliance on one scenario, and it does give investors and banks a bit more of a glide path to adapt to changes in their capital requirements. And it's not just investors that need that. There's a whole host of constituents that banks have, employees, customers, communities, and shareholders that are vested in and dependent on their capital allocation decisions. So giving a glide path and some predictability is helpful. So averaging can help with that by providing some smoothing benefit and reducing the over-reliance on the scenarios.
Thanks a lot. So one of the things we're going to do when we get to the Q&A session part of this, we're actually going to, as long as they're not too long and wordy, we'll actually have people comment. Like I'd invite people to say, what do you think? Are there any other insights on how to sort of address the flaws in the models that we've been using? Are there other ways in which we can do that or address volatility? The next issue we're going to talk about is Pillar 1 versus Pillar 2. Now, most of you in this room, very sophisticated, probably know what the difference is. But as I said at the outset, Pillar 1 is the minimum capital requirements. The SCB, when the way we do with our stress testing, it creates a Pillar 1 minimum capital requirement. I'm going to ask the next question to Nat here to my left because the Bank of England does it, very differently. And actually, he'll have to explain what Pillar 2A is because I probably can't do it justice. But they use sort of a Pillar 2A approach. And in any event, rather than having a supervisory annual stress test, they have a test every other year. And I understand that the Bank of England considers both its supervisory assessment of the impact of the stress test and the UK bank's own assessment of that impact in determining the buffer requirement in addition to the fixed capital conservation buffer of 2.5%. So it's more of a discretionary add-on to the CCB. And so if you could just tell us about your approach and maybe contrast it to the US, that would be great, and sort of why you've chosen that as opposed to the approach that we've chosen.
Yeah, no, thanks, Randy, and thanks very much for having me. So as you say, No, I should have pressed that. As you say, we updated our approach to stress testing the banks at the back end of last year. And if we take a step back, we do feel in the UK our stress testing approach to date had served us well. I mean, as Till and you and others have said, they were a big part of how we managed to stem the crisis in 2009. And on the back of the crisis, one of the mission number one for financial stability was to strengthen the banks, and our stress tests were instrumental in achieving that. So we feel it served us really well, but in recent years we started to use them in a different way. To deal with several things that had changed in the system. And so we felt it was right to take stock and to refresh how we're doing it. And our objectives were twofold. First, we wanted to ensure we did it in a way that reflected how the financial system had evolved over time. And the other thing we wanted to do is to ensure the burden on firm was proportionate to support their competitiveness. So we did three things. First, we moved to running a full-blown bank capital stress test every 2 years instead of every year. And the only reason why we felt comfortable doing that is because banks were strong enough that we felt we could get the answers we needed by doing this full-blown stress test every 2 years. And we've got one going on this year at the moment. And the quid pro quo for all that is that it does free up a lot of resources at the banks, which can then be used to invest in their own risk management. The other thing we are doing is that in the intervening years, when we're not doing a full bank stress test that sets capital, we are checking, still keeping an eye on the resilience of the banks, but in different ways, in ways that are less resource intensive for the banks. And the other thing we are doing, because of that capacity that is created, is pivoting towards doing more and more exploratory scenarios, which don't lead to any capital answer, but which helps us and the participants in the stress test be better prepared for shocks. So that's what we are doing and how we are evolving our approach to stress testing the banks. Now, we are indeed doing one at the moment, a full-blown bank capital stress test. And that does inform the capital requirements for banks. And so in terms of the question about how it works, as you say, we use firms' own estimates of the impact of the scenario as the starting point. And we have our own models, our own estimate of the impact of that same shocks. And we use that to kick the tires, to challenge the estimates of the firms. That's the approach we have been using for a long time, and that's the one we're continuing to use. We do that for several reasons. First, it gives us multiple analytical perspectives on the answer, and it helps us triangulate what the impact is of that scenario. We do it because the reality is that we would struggle to guess accurately the behavioral responses of the banks to some of the scenarios of each individual banks. We also think there is, for the UK, there's merit in using the same models that banks use to inform their own risk management and their own capital planning, because it's important that banks get that right too. And this also enables us to benchmark firms and their own modeling capabilities. So, for example, if you've got two identical or very similar asset portfolios and the same scenario, and different banks come up with different answers, then obviously we can kick the tires. And if one bank has a lesson to learn in terms of its own stress testing methodology, we can have that conversation. And finally, I mean, we have to be honest that our own modeling capability isn't perfect, and we would struggle to capture the full riskiness of banks' activities. And that's why when we do a desk-based stress test, which is only us, only our models, we don't publish individual firm estimates of that, only aggregate estimates. Having said that, in aggregate, our own models have proved reasonably good at anticipating the total impact of shocks on the banking sector as a whole. So, usually when we then get the answers from the firms, it's pretty close in terms of sector-wide level. So that's that in terms of which models we rely on. Now, in terms of the link with capital, we don't really think about it in terms of Pillar 1 versus Pillar 2. So then that's where I come to this Pillar 2A thing. Instead, we think about it in terms of minimum requirements versus usable buffers. And for us, minimum requirements is Pillar 1 and Pillar 2A. And Pillar 2A is very simple in the UK. It's the risks that we know are not included in Pillar 1, like, for example, interest rate in the banking book, which we discussed this morning, and which is very relevant these days. So those are known risks that are not included in Pillar 1, and we have published methodologies for how to calculate Pillar 2A estimates for those risks that are missing. And often those methodologies rely on stress scenarios, and that applies to all the banks in the UK. So that's for the minima. On the buffers, the usable buffers, we're including that the capital conservation buffer, the countercyclical buffer, and the firm-specific supervisory buffer, which we call the PRA buffer after the prudential regulation arm of the Bank of England, which is firm-specific. And the way it works really comes back to how do things play out, how do we want things to play out when a stress actually happens. When a stress actually happens, we want firms to stay above their minima, to stay alive, to stay operational, but also we want them to continue to lend to the economy. And as what we typically do in those circumstances is that we release the buffers, as we have done recently. So what we want is firms to be able to stay above their minima, having used all of their buffers in order to lend to the real economy. So that's what we want to happen in reality. So in terms of what that means for our stress test, we assess how much capital a firm needs to stay above its minima, having run its buffers, and we deduct the conservation buffer and the countercyclical buffer from that impact, and the residual is what feeds into the firm-specific buffer. So we avoid the double count via that means. But there are other things that feed into the buffer. It's not mechanistic, and it's very much firm-specific. So the impact of a stress test is one thing. Another thing can be, in the case of some firms, risk management and governance, because typically firms who are less good at it also tend to be more prone to losses. So that's a conversation that supervisors have with the firms, and as and when they improve, well, that gets removed, that bit of the buffer. And finally, there may also be other risks that the firms themselves have identified which warrant some extra bit in the buffer. So there's several things that feed into the PRA buffer. And it's much broader than just the output of the stress test, and it's an integral part of the supervisory dialogue with the firm.
Thanks a lot. That was fantastic. So I think one of the themes that has come up in bank supervision over the last few years is to actually encourage boards of directors to provide credible challenge to management, and for various people in the organization this is actually credible. We're inviting credible challenge to our stress testing process and how we do it by talking to by listening to sort of how the UK does it. Bank of England always has interesting ideas. But let me turn to John. We're actually going to dive a little bit deeper in this from the U.S. perspective in terms of responding to what Nat said. And so, John, if you could just tell us how you think U.S. banks or U.S. investors, would they prefer the Bank of England's discretionary approach, not, sort of obviously 2A and 2, is it 2A and 2B, or, sort of constrained discretionary, but ultimately discretionary, over the Federal Reserve's Pillar 1 approach? And then sort of a related question is, should the Federal Reserve decouple its supervisory stress test from the Pillar 1 capital requirement, and, why or why not?
Thanks, Randy. So I think from the perspective of U.S. investors and U.S. banks, they would first readily acknowledge the merits of the approach that Nat described and consider how we can incorporate some of those benefits. I think at the end of the day, there's an overriding concern that pushes most of the U.S. banks and many investors to the side of keeping stress testing as the driver of Pillar 1 requirements. And I think the main concern is that moving to a fixed CCB system could have the effect of empowering and perhaps pressuring supervisors back to adjusting capital requirements in Pillar 2. What we've seen over the last decade is that a lot of supervisory activity happens behind closed doors without disclosure, transparency, or accountability. Keeping public stress tests as the driver of Pillar 1 capital requirements does hold the supervisory system accountable. And both banks and investors want capital minimums to be driven by a process, not by people or politics. So, I think you could imagine in a fixed CCB world, there would still be Dodd-Frank mandated stress tests. It's not hard to imagine a scenario where a few banks do poorly on the stress tests and supervisors might feel pressure to do something, and they might require those banks to run with more capital. In that scenario, we've kind of backdoored our way back into an SCB process anyway, except it'd be done kind of behind closed doors. So I think the argument is to keep it public and keep it transparent the way it is now. And the background story here, and Randy Quarles touched on this with his breakfast analogy, is that both banks and investors have a lot of emotional scar tissue around the evolution of the stress test. There were years of worrying if a foot fault in their models or a bad relationship with the supervisor or not filling out their work correctly could lead to a quantitative fail or a qualitative fail. So I think that fear of moving back to a Pillar 2 system has most banks voting against decoupling. One other concern around decoupling is that we could risk losing some public faith in the system and the process if markets and the public don't see some consequences to the stress tests and some modest explainable variability year to year in the SCB results, both across banks and across time.
Okay, so the next one, digging down a little bit, is for Till, since he was one of the designers of the SCAP, and has had many years, being one of the leading experts on stress testing to sort of give us his perspective. So, if you had three different choices, so blend the supervisory and company-run models the way the Bank of England does. That's one option. The other is to rely exclusively on the bank-run models for certain projections, with the Fed supervisory models acting as a backstop for the projections. Or incorporate each firm's projections and data into the Fed supervisory model. Any thoughts on the pros and cons of any of those, and which one, if any of them, or some other one, would you favor?
So the U.S. stress testing regime is unusual in putting all of its stress testing capital eggs into the supervisory model basket, if I stretch that metaphor a little bit. So it puts really a lot of pressure on those models to perform reasonably well. And in that way, the U.S. regime is more exposed to model risk, really, than other regimes are. What's more common is what Nat described, which is to blend the supervisory model output and the company-run output. I talked earlier about imperfect models and model risk, and one way actually, and a really good way to mitigate against model risk, is to average not just across scenarios or across years, but actually to average across models. So I think the idea of averaging across both the supervisory and the company-run models to arrive at a final result, I think is an idea that's worth very much exploring. Now, it's not obvious that you would, to me anyway, that you'd want to weight one more than the other. At least in peacetime, it's not obvious to me that you would want to do that. You mentioned, I think you meant PPNR. PPNR is sort of, which is pre-provision net revenue. That's notoriously difficult to model for anyone. There's in this model averaging and using of company-run models, one of the concerns is that, well, the banks are going to undershoot losses. On average, that's true. We know that from the disclosures that bank loss projections tend to be lower than Fed loss projections, but company-run PPNR projections tend to very often be higher than, be lower also, sorry, than Fed projections. So it's not clear that systematically across everything that the company-run projections are going to push the SCB down, probably a bit, but the averaging will mitigate against that. The concentration, however, in one set of models is probably across all things what makes me most nervous. It makes me more nervous than the idea of having company-run model results push the SCB down further than it would otherwise. Now, all of that is in peacetime. I think in a crisis, I would err towards putting most, if not all, of the weight on the supervisory models rather than have a blend of the two. But in peacetime, a blend, I think, is the better way to go.
Okay, Kate, I'd love to have your views, particularly on whether the Fed should decouple stress testing from Pillar 1. capital requirements, and how do you deal with the lack of comparability? One of the problems with going to a more discretionary test is that it's less comparable firm to firm. So if you could address those issues and kind of which of the various alternatives that we've talked about or the Fed's current position, you can always vote in favor of the current process as well, but in any event, it'd be useful to have your thoughts on that.
Yeah, no, I mean, it's a great issue, and it is an important issue to discuss, just because, again, the U.S. is an outlier. So whenever the U.S. is an outlier, you want to figure out, like, why are we doing this differently? I do think at times it's also important to understand, like, the history of the SCB. Randy Quarles gave an incredibly articulate and thoughtful explanation this morning, and it was implemented, of course, on his watch. But it was initially proposed by Dan Tarullo. So it's important to realize this isn't something that has a clear partisan bent one way or another. A lot of it is the rigor of the test, not kind of like where you situate it. And so there's room for flexibility across these two different issues. I mean, I think part of the question for Pillar 1 or Pillar 2, and I think the characterization of 2A is really a beautiful way to do it, or it could be like 1B, is like, it is inherently something that's in between these two, right? So if we think about it historically, it was used in SCAP very significantly, where you needed to recapitalize. It was a tool of recapitalizing the banks. So we needed information to figure out how to recapitalize them that made the assumptions underlying the stress test actually credible, because we were already in a distressed environment, and you wanted to stop the ongoing fire sales and pressure that was happening. Whereas when you're in peacetime, you're actually thinking very hypothetical, you're thinking in forward-looking ways. It's just a completely different exercise. And again, part of the reason it also got paired with capital so tightly is it's an important counterbalance to what we know is like the biggest drawback of capital measures, which is they're backward-looking. They're incredibly backward-looking. And so the idea is we wanted something like forward-looking to balance it out. So there's reasons those two came together, but that doesn't resolve the Pillar 1 or Pillar 2, as I think the Bank of England example nicely brings out. I mean, the other thing that the Bank of England example nicely brings out is, I like the recharacterization, not as Pillar 1 or Pillar 2, but is this something that you actually want banks to be able to use when times get tough? Because we, in terms of looking at the financial system, need banks to be able to provide credit when times are tough. Or is this instead something that is a sign of strength, and we also need people to have faith in the banking system during periods of stress? And so how do we balance these two? And that goes back to, like, when we got the SCB, the capital conservation buffer and the SCB are doing very different things. And so we kind of think about the history like, okay, well, these things are compatible, but I think Nat's breakdown shows that they are not compatible at all. Like, the SCB is saying, like, look, this is how much banks need to endure the stress that they're currently facing. That's not something you want to tell banks that they can use during periods of stress. The capital conservation buffer, like the CCYB, is instead saying, look, the banking system plays a really important role during periods of stress, trying to provide credit to the real economy, and we need them to be able to play that. So I think there's like a bigger kind of conceptual issue that we need to think through and be honest about. Is this something that we want to make usable, or is it not? Right now, with the SCB, it's not going to be usable. The last thing I would note just briefly on this are questions around legal risk and how much concerns about legal risk might be driving some of these changes. I think the Fed's brief actually was a remarkable brief, explaining why the current regime works potentially as it does, but I do think the perceptions of legal risk as opposed to optimal policy are driving changes. Then there's reasons to think, well, maybe we need to restructure where we put this in the overall framework so we can back to think about, like, what's optimal policy for the health of the banking system and the broader economy, and not let kind of like indirect concerns about legal risk undermine or deviate too much from what would otherwise be optimal policy.
So I'm going to ask one more question, actually, to John, then we're going to open it up to the audience to ask questions. And that is, so how much capital do the banks actually have in practice? In other words, what drives bank capital levels other than the stress testing or the minimum capital requirements? And is there a difference between the GSIBs and the non-GSIB LBOs, I'll say large banking organizations? So what role does the market play in deciding sort of what the capital is that banks actually operate with?
Yeah, so if we think about the everyday kind of capital targets that banks run at, for the GSIBs, the stress test results, the SCB actually does drive changes in where they're targeting to run. For a whole host of other banks, the actual day-to-day stress test results don't drive where they're running at. So, for example, you have super regional banks that have CET1 ratios today and targets in the 10 to 11% camp, even though their minimums are 7. So they've got 300 or 400 basis points more than their capital minimums. And there's a few reasons for that. First of all, the reported ratio for capital for regional banks don't include AOCI, and it does for the GSIB. So in a period where banks are still carrying sizable unrealized losses on their balance sheets, the regional banks will have to hold more capital just to be kind of on par or close on an AOCI-loaded basis. And second, beyond regulatory rules, markets and other constituents also impose capital requirements on public companies. So in the case of banks, you have fixed income markets, equity markets, and rating agencies, all of whom are kind of requiring regional banks to run above their capital minimums in that 10% ballpark today. And that's kind of why they're still there today. And even in a post-CIV-B world, even without market pressures, banks often worry that the Twitterverse or other social media forces can create the impression of problems at banks. And this is during wartime. So it's another reason regional banks probably don't want to get their capital metrics too far away from the biggest, safest, too big to fail banks. But I think it's important to keep in mind that if the cumulative changes that occur in the system allow big GSIB banks to run with less capital, we could see smaller banks run closer to their minimums. That doesn't lower the minimum requirements for regional banks, but it could lower the buffers that they run with.
Okay, thanks. So I think we actually have time for one more question before I open it up. So I'm going to ask Kate. I was going to say we didn't have time to talk about exploratory scenarios, but I think we do. So anyway, Kate, can you tell us in your mind what the view of what the value of exploratory scenarios are? And then Nat, you talked a little bit about exploratory scenarios. I have to say I'm completely intrigued by the one thing in the paper about reverse stress testing. I know that's one of the things you did during COVID, but I'd like to sort of hear both of you talk about exploratory scenarios and the values, or the pros and cons. Maybe there's some cons to them as well.
Yeah, I mean, I think they've been actually an incredibly important addition to the tool set. I mean, precisely as we've already discussed, whether you're talking about Pillar 1 or Pillar 2, when you're running a stress test in a way that it's going to feed directly into a bank's capital requirement, odds are you're going to hedge a little bit the types of questions that you're going to ask because you don't want to have extreme volatility from one year to the next with respect to the capital you're asking banks to hold, to use to fund their activities. That being said, like the value of the stress test is to keep banks on their toes, regulators on their toes, and to like develop information, not just on a bank-by-bank basis, but also on a system-wide basis. Like how would various types of shocks, because we know there's all kinds of different shocks that can hit the economy, how would different types of shocks actually affect like different parts of the banking system, and also how effective are the banks at understanding how those different types of shocks would affect their profitability and other aspects of their activities. I mean, they were formally introduced as part of the stress testing structure in 2023. I think that, again, was a really important introduction. But I would also say, when we discussed earlier, that during 2020, the Fed ran, they said, 7 different stress tests. And I think that was incredibly useful. And I would consider that a kind of a form of exploratory stress test. Once a crisis actually hits, even if it's early stages, you're no longer engaging in hypotheticals. You're trying to figure out, okay, here's something that's just on the precipice, but potentially could get worse, and you're making decisions over whether or not to allow banks to continue to pay out dividends. I mean, having real-time information that's going to be imperfect and dependent on highly flawed models, but still meaningful, closer to real-time information, I think is incredibly useful. And so I think having that be part of the overall tool set that you're using on a regular basis makes you far more prepared to adapt. And then just finally, I mean, we had this like great conversation at lunch. I mean, there's just like such a possibility of different types of disruptive changes. And I think you can ask, like whether something's growing really quickly, whether profitability is really quickly, you can really ask about things that are like on the margins as tail risks, but potentially could be disruptive in different types of ways. And I think it's a great exercise to continue to undertake.
Okay.
Great. I very much agree with what Kathleen said, and one of the key reasons why we're using exploratory scenarios more and more is that the financial system has changed a lot, and with that, the roles of the banks within it. So we want to point our stress testing toolkit towards answering a much broader set of questions than whether a given bank has enough capital or not. Because although that still is a fundamental necessary condition of financial stability, it's more and more becoming an insufficient condition for that financial stability because of how different the financial system is now. For example, with the prominence, as we discussed yesterday, the greater prominence of non-banks and market-based finance playing a much bigger role in the provision of vital services to the real economy. Banks are still very much involved, notably by being by far the main providers of leverage to non-banks, either in core markets, sovereign debt markets, for example, to hedge funds, or in private finance market like private equity or private credit. So banks are still very much involved, but in a very different way to what their involvement was in the past. So we sort of felt we had to pivot our toolkit to make sure that we and the industry understand what these type of new paradigms mean for financial stability and for growth ultimately. And specifically, so we did last year a new kind of stress test, which was our system-wide exploratory scenario. We love talking about it, so I'll be very brief about that. Where we basically stress testing an entire market, an entire ecosystem, and core UK markets, so the gilt market, the gilt repo market, and associated derivatives, with many participants beyond bank, including hedge funds, asset managers, etc. And to understand first how resilient the markets would be to the shock, and second, how the behaviors of the participants could amplify that initial shocks. And what that meant for how those participants should adjust their playbooks so that if one of those shocks does happen in the future, they're better prepared for it. So the answer is not more capital, more liquidity, it's just being better prepared when those shocks happen. And some of those shocks have happened, even very recently. So it is very helpful, and the benefit of that we saw some of that in the recent turbulence. So those system-wide exercises have a bright future in our mind in the UK. But even just for banks, and coming back to exploratory scenarios, just for banks, for the banking sector, these have been very helpful. And for example, when the pandemic hit, we ran a desk-based stress test on the scenario that our monetary policy committee had published, an illustrative scenario about how the stress could evolve through and propagate through the economy. And we wanted to know something very simple, which is, well, how would the banking sector react to that shock, to that scenario? So we did it, we ran it, desk-based, and we got the answer that they could withstand the shock and continue to support the economy in those conditions. A few months later, in August, we ran a reverse stress test because we wanted to know, the scenario had started to unfold, and we wanted to know how bad it would have to get for banks to start to be constrained in how much lending they could do to the real economy. What would it take for banks to run down their buffers? We talked about the usable buffers. The reverse stress test told us that. And both of those things meant that we could say, when we ran those tests, we could say to banks and in our public communications during that period in the start of the pandemic, that we expected banks to continue to lend to the economy. That was one of our big messages at the time, because they were strong enough to do it, and because there was one of the key roles they had to fulfill in those circumstances. So that was one of the uses of those exploratory scenario. Last year, we ran another desk-based stress test of the banks at a time where there was great global uncertainty. And it was very difficult to anticipate where things would go. You can still say the same now. And we ran it, we talked about running multiple scenarios before. Well, that's what we did. We ran two scenarios, a supply shocks and a demand shocks, one with interest rates going up, the other one, interest rates going down. So we did not have to guess which one was the most relevant or the most plausible. We ran both using our desk-based toolkit. And that was very helpful thing to do. And it informed indeed what type of scenario we are using this year for our full-blown bank capital stress test, for example. So those are the type of things which don't necessarily lead to capital, but they help us answer a much broader set of questions and help the markets more generally being better prepared. So let me pause here. All these things in our mind, they have a great future. And we feel that's an important way, an important direction towards which to point our toolkit. But what's for sure is that that's here to come, and especially is as memories from the global financial crisis are fading, because yet stresses do keep happening.
Thanks a lot. So we're going to open up for questions. I'm going to hope that the CFO panel will actually address one thing we don't have time, which is we can see the benefits. We've certainly talked about the benefits of exploratory scenarios, but what are the costs to the banks if we're doing exploratory scenarios? Yeah, so I think we've got a question here in the front. Sharon?
Hi, Sharon from Morgan Stanley. Till, I had a question directly about something you said that I didn't fully understand. So I actually agree. I think there's a great benefit to using some of the bank's own models within, working with the Fed to help them understand both where we come from an industry perspective, changes. I think a lot of the bank models right now are done on an industry level, particularly when you think about expenses, for example. And that, I think, does create a lot of challenges with the underlying results that you end up seeing from a stress test. But you said something where you agree with that in peacetime, but then in periods of stress, you would use the bank's models. Now, as we know and we saw in COVID, you have periods of stress that are pretty immediate. How would you move to the Fed models so quickly, and how would you make sure that you're holding enough capital? I didn't quite follow how that would work.
Right. So just to be clear, I think in a crisis, I would err towards using just the supervisory models, or mostly the supervisory
But how
models.
would you go back? I mean, I guess
Right.
how
So
would you flex?
Right. So a key question there is, and this is always whenever you have these discussions of peacetime versus wartime, as well, when do you know that you're in wartime? Yeah. So I'm going to punt on the question of when do you know when you're in wartime, because it's an admittedly very difficult thing to decide. But you could also make that gradual, so that if you're not quite sure, but you think that it's on the horizon or it's on the threshold, or you might in fact be in it, then this blending approach will allow you to shift gradually more and more weight towards the supervisory model if you're not quite sure. And if then there comes a point where you're quite sure, in late 2008, we were pretty sure we were in one.
I was just more thinking of COVID, right? You one day woke up and there was a global pandemic. You weren't really that sure. It took 2 weeks and all of a sudden we were all at home. So it was a little...
Right, but 2 weeks is pretty fast.
Yes,
Yeah.
that's my... Thank you.
Back there in the middle, in the back. Yep.
Hi, Luigi Di Gengi from Davis Polk, a.k.a. one of Randy's former partners. This is a question really almost more, it's directed to the panel, but more directed to Mr. Benjamin in particular, which is, if you're going to try to create a balance between reliance on bank models and supervisory models, how do you strike that balance? Or to put it another way, will you do it based on a particular percentage variance between the results of the models? So you say, okay, I'm going to rely on banks' models up until they vary up to a certain percentage from the supervisory results, then I'll question them. Or is it based on supervisory feedback and discretion, which obviously is less transparent?
Yeah.
So just to be clear, our starting point is to use the models that banks, so the estimates that banks submit to us. Typically what we see is that in the aggregate, basically both type of approaches agree and point to the same answer. We've never really had any issue on that front. Where there's more variation is firm by firm, bank by bank. So when there is a variation between what our models say and what the bank's models say, we ask why. And we have that conversation bilaterally, privately with the bank. And sometimes there's a good reason for it, maybe better risk capture or something else. And sometimes there isn't. And in that case, then that leads to an adjustment. But it's a conversation, a private conversation we have with the firm. One example, for example, and we talked about the difficulties of modeling net interest income, which you called PPNR, I think, here, is what assumptions do you make about pass-through of the rates that are paid on deposits, for example? And you can have different firms making very different assumptions, and because we see what everyone submits, we can say that, in a world where there's competition for deposits, not everyone can be right at the same time. So that's an example of an adjustment we would make to a firm's estimate. So that's how we've been running it for a long time now.
Got one back here, and then Daryl Duffy. Sorry. Yeah.
Looking at me. I was just going to pile on the PPNR issue. I think the notion of going back and forth between bank models and Fed models doesn't work no matter how you weigh them unless we get the Fed models right. I think you'll find universal agreement amongst the banks that the PPNR approach that the Fed takes, it's one of the reasons we've all screamed, is just wrong. So I want to be really careful about some assumption that, hey, we can use ours sometime and then just jump back to a bad model. The whole exercise on having transparency with the Fed models is to hopefully be able to, put eyes on whatever is causing the variance that we see every year when we do this. Severe enough, just as an aside, our firm, for example, right, we always try to solve an outcome worse than whatever the Fed's going to come up with, and the only way we can ever do that is just bin a giant operational loss into our results because we don't have any idea what the Fed model's doing. The second point I would make that I do think is really important, and I think the UK gets this right, is some risk measure stress around interest rate risk in the banking book. We have no measurement today in the US that looks at this, and we need to. And then the final thing I would just remind everybody, to me, the stress test, we do multiple stress tests continuously. The stress test shouldn't just be about a pretty bad thing that we can all survive. It should actually it should be about the thing none of us can survive. When you run a risk book, you always figure out, that's what you do all day long, is what's the thing that can get me fired? What's the thing that blows me up? And there's always something, right? There's always a weakness in the system. And so in the scenario design, not that I want to publish and scare everybody, but I would actually spend time in the scenario design and the what if, these alternative scenarios, to what is the worst case that we can come up with. And I can come up with a lot that would scare the heck out of us. I don't plan to that scenario, but it's good to know what that is.
Could you just pass the microphone over to your right, and then if we have time, then Daryl Duffy next. Yeah, no, right there, yes,
Yeah,
you, and then
quick
Daryl.
question. Scenarios, models, exploratory scenarios, there's a lot of potential cost here, and I think you were going to raise this issue. My question is whether this activity, stress testing or process, lends itself to efficiency gains, perhaps substantial resource cost reductions via artificial intelligence.
Okay, so anybody want to answer that? Was there a question? No, okay. Daryl, do you want to ask?
Sam
the
Altman
last
has left the
question,
room.
sorry. Okay.
Great. There's been quite a bit on the costs and benefits of multiple scenarios, among which you already mentioned volatility of capital requirements on the one hand. Several of you mentioned the benefits of getting more information about different types of stresses, but none of you have discussed it. I noticed the extent to which a bank may have an incentive, if there's only one scenario, to adjust its business model and its balance sheet towards that one scenario. Is that a significant risk, especially when the tests are quite transparent? Or do you have the opportunity to change that one scenario often enough that banks would not have time to all tune themselves to that one scenario with the attendant risks?
Okay, John, then Till. Yeah.
Go ahead, Till. I know there's six. There are 6 bank CFOs coming up next. Who'd probably really answer that question well.
Yeah, so I do think there is a risk of this. I think the risk is not so much that you do it from one year to the next. I think the risk is more that for some, I mean, really, if you look at the DFAST program since almost its inception, the shape of those scenarios has not changed much at all. Many of the sort of core variables, core stress factors, the basic shape has changed, like literally almost not at all, for GDP and unemployment and house price indices and so on. So over time, you're kind of teaching the industry to just focus on these tests, these scenarios. Everything is just pegged to this one scenario. So over time, it's very natural for banks to respond in kind, because keep in mind that all a stress test is a very, very bespoke risk weighting algorithm. It's not really anything different. And so if we think that banks will respond, you know, either desirably or undesirably to a particular risk-based capital regime with particular risk weights, we shouldn't be surprised that also they will respond, you know, similarly if the same scenario, more or less, over and over and over is presented to the banks, and they'll shift their business model.
Okay, go ahead.
If I may. So, I mean, I agree with the sentiment behind your question, Darrell, about the merits of being able to run several scenarios. That's why last year we did that with our desk-based capability. So this was not a full-blown capital stress test, you know, setting capital requirements, requiring submissions from firms, but we used our own models, our own technology to do that, and we got a lot out of it. And that's then linked to the next stress test, which did set capital. So that's a bit of a halfway house to get to your point. In terms of efficiency, I very much agree with the point on efficiency. But the fact of moving to every second year instead of every year on a full-blown capital stress test, you know, does mean a considerable reduction in burden and in resources spent on those capital stress tests. And the capacity that gets freed up by that, we very much expect that will be used by banks to improve their own risk management for that. But there has been a big reduction as a result of that.
Okay, thanks a lot to our panel. Very interesting. Thank you very much.